Another check on the markets today. Stocks closing well off the lows of the day as investors await more inflation data this week. The Dow jumping 100 points, notching its seventh positive session in 8. The S&P eking out a small gain, up 0.1%, and the Nasdaq just barely closing out in the red. Well, bank stocks higher across the board today as the countdown begins for the kickoff of earnings season. Friday, we get Wells Fargo, Citi, BlackRock, JP Morgan, and PNC. Next week, we'll hear from regionals. And based on what we saw last month, those numbers could be quite ugly. Our next guest fears another handful of banks will likely go belly up before the end of the year. Sheila Bair is a former FDIC chair. She held the post during the 2008 financial crisis. Sheila, great to have you with us.
Thanks for having me.
When the regionals start reporting, what is the one thing on their balance sheets that you'll be looking for, which will tell you whether or not there's going to be more trouble ahead?
Well, I think so. Everybody's focused on their HTM and their level of uninsured deposits. I don't think this is a problem unique with regional banks. There's been a lot of language around this. I think the vast majority of regional banks, the vast majority of all banks, are just fine. But there are a handful that still have high reliance on uninsured deposits. Although that's changing, we're seeing some of that readjust and convert into insured. And they've got a lot of HTM. They have a lot of CRE, too. I think the CRE is going to be a focus for all banks, and a need for better clarity, perhaps, around what's within that CRE, how much of it is office exposure, which could get ugly.
There's a number that was thrown out by the current FDIC chair at the end of last year, or maybe it was the beginning of this year in a speech, and he said that there's combined in unrealized losses for available for sale and held to maturity. The unrealized losses total $620 billion at the end of 2022. How should we think about that number in terms of, you mentioned the vast majority of banks are fine in terms of concentration and where that stands right now? Right.
So it's not a problem to have unmarked losses in your hold to maturity portfolio if you have the intention and the ability to hold them to maturity. You won't. I mean, they're going to be low yielding assets, so it'll be economic losses. But in terms of eroding capital, there should not be. If you can hold them to maturity, you can redeem them at par. And so banks that have stable funding, a lot of insured deposits, loyal uninsured deposits, long-term debt, it's not a problem. They can't hold them to maturity. I do think there needs to be more rigor, particularly among the auditors, in terms of scrutinizing what has been put into hold to maturity to make sure the bank really does have both the intention and the ability to hold them to maturity. Obviously, that was not the case with the Silicon Valley Bank.
You mentioned commercial real estate, and I think a lot of people are really focused on that. Not only did these banks extend a lot of loans, but the assets are worth less. And so how do you think about this problem at this point in the cycle?
Yeah, so I think certain segments like multifamily, we need more housing. So I'm thinking that's, I don't think you can't group all CRE together. A couple of things. There's refinance risk. There's a lot of it that's going to be refinancing over the next few years. So the ability of the borrower to be able to refinance at a rate that's affordable with rates much higher now. I think we should think about that. Again, we need more transparency, particularly the big banks, too, about what's office. CRE is a big category. Some of it's just fine. Some of it, office, especially in urban areas, is presumably under significant distress. So we need to know clarity about what that looks like. But CRE, though it's a big percentage of bank lending, the office component of that is much less. And if banks are appropriately reserved against losses, these are risks that can be managed. But I do think we need more transparency around what's in those CRE portfolios.
Hey, Sheila, this is Courtney here, and thanks for joining us.
Sure.
So there's been this question of, do the banks need to raise interest rates, right, or raise their deposit rates in order to really make it fair for what's happening with interest rates right now? And I guess my question is, how much of that do you think will happen, especially with the bigger banks right now, who I think a lot of people are looking at more as safety than your regional banks? And are they going to get away with lower deposits because they're the safer option right now? Whether that's the case or not, I'm just curious what your take on that would be.
Yeah, no. So I think the earnings for the big banks, the earnings should be pretty good for this quarter. But I think the pressure to raise deposit rates is there. And so I think in the second quarter, you're going to see a lot more compression of interest rate margins. They're getting a lot of competition from money market funds right now. Some of that is healthy. Some of it, I think, is distorted because the Fed is providing massive, massive returns to money market funds through their overnight reverse repo facility. It's basically the equivalent of a bank reserve account that the Fed created. Money market funds are heavy users, nice, generous returns. That is creating an uneven playing field, I think, for banks, because banks do have regulatory requirements for safety net programs like reserve accounts, and money market funds don't. So that's something the Fed should address. I think they should lower the rate that they're paying on the reverse repo facility now, and that could help ease pressure. But that said, those interest rates on deposits need to come up. It's the right thing to do, but it's also, the competition is going to force it. But still, it's not a problem. Loan rates should still be higher. They'll still should be able to make a healthy margin, narrower. But again, the vast majority of the banks, I don't think it's going to be a problem.
Sheila, always great to speak with you. Thank you.
Yeah, thank you. Nice being here.
Sheila Bair, what are you expecting from the big banks, Guy? Because when I hear deposit rates will have to go, savings rates, CD rates, whatever it is, they have to go up. I hear NIMs go down.
I'm not sure. Listen, I'm not sure the big banks are going to pay more interest. They're in a position now where people are going to say, you know what, I'll forego 1%, 1.5% for the perceived safety of being in a JP Morgan, Wells Fargo, Bank of America, Citi, as opposed to some of these regional banks. So, yeah, they should do a lot of things, banks. I get it. I mean, in the real world, they should raise rates for people. I just don't think it's going to happen. Even if it does happen, let's just say, the environment that banks find themselves in is challenging, to say the least. I mean, I think that regulation is coming whether they like it or not. The economy is slowing whether they like it or not. And I think their earnings potential is going to be impacted by all that. So this quarter might be fine. I think guidance is clearly what you want to hear, and I don't think it's going to be particularly good.